We're back and we're talking MicroStrategy.
Ryan, good morning.
How are you?
Very good. Very good.
So, MicroStrategy is a company founded by Michael Saylor. It's got a bit of a history. Early 2000s, it came to a crossroads where it was dying a slow death. Talk us through what MicroStrategy was and what the problem that they were facing was. And yeah, go ahead.
Yeah, all right. Okay. So just maybe we'll back up a little bit around. So firstly, I've got a position in strategy. So they've evolved from being MicroStrategy now to be strategy. So I think their ticker code is the same, MSTR, but their strategy is the company now. I think earlier this year it might have been they changed their title.
They changed from MicroStrategy to strategy.
Yes.
I'm a holder as well, for disclosure.
Yeah.
But I don't hold any of the other products, any of the dividend stuff, and we're going to get to that further down the track.
Yeah,
but the MSTR is the main one that you're looking at on the NASDAQ. Correct. When you Google it, superhero shares, whatever.
Yeah, so what I'm probably keen to discuss with you is just their evolution, but also where they sit today and why they may be something that could be the most valuable company in the world, I'd say, in 5 or 10 years. And
probably on that comment, I'll just say this is not financial advice.
Correct.
We're just having a chat about markets and stocks. And
that's right.
It's a Bitcoin-related stock, but it has an underlying evolution that is very different to what the market has seen. And markets are disrupting. You know, Microsoft, Google, these huge tech, Amazon disrupting businesses came in and disrupted the industry, and they became the tech leaders of today, multi-trillion-dollar companies. So that's why it's intriguing.
Yeah. So yeah, spot on. This isn't financial advice. It's something that I'm watching and reading a lot about and have done so, just because of not if it's what it's generated in I suppose wealth for Michael Saylor and those who bought shares, but more on what it's doing and what problem it's sort of tackling. So, and we'll get into that a lot. But so yeah, strategy is the underlying company. Michael Saylor, founder in I think the late 80s, something like that. They had enormous growth through 1990, 1996 before they were listed. I think their revenue was growing. I read up around 100% a year during that period. And they actually were able to secure contracts with, like McDonald's was one of their biggest contracts, which, I mean, back then, particularly, even today, McDonald's huge. They were 10 million a year in revenue. So they'll go in places. I mean, they're a software-based business.
Data analytics.
Today, it's more data analytics and AI sort of driven. I know it's a fashionable sort of thing, but mobile AI is what I've been reading up, but and I assume they've evolved with the technology evolving. So their growth was really strong, and I think that's what brought them to go to the public markets in 1998. So they listed at around $10 a share, and really had continued on their success of the 1990s. Obviously, we're hitting the .com era in sort of late 1990s into 2000s, and obviously had a correction. So they've done quite well through to sort of up to the 2000. They did hit a hurdle. And this is interesting around, so they ran into some accountancy issues whereby they had to restate revenue or their financials for the years 1998, 1999. And at this point, the share price had run up from $10 something to $330 a share. And this is back in 1998, 1999. So you'd seen enormous growth, a lot of upside, a lot of this was baked in, right? Clearly, and we saw that in a lot of .com type companies. So these guys are riding that wave, and I don't think I've come across something that's corrected so hard. So the subsequent years, once this restatement came out, it ended up having MicroStrategy had to deal with 24 lawsuits from clearly shareholders who really were disappointed and a plummeting share price. We're talking a share price that was sitting in the $333. It got as low, I think, as I think around 43 cents per share. at a low point. So, that's a lot of
99 point
distraction.
something
Yeah.
percent loss.
Yeah, and
Business ending sort of territory almost.
correct. Yeah.
Yeah.
So, that's interesting in itself. And at the helm of MicroStrategy at the time and strategy today is Michael Saylor. So he's, I believe he's an aeronautical engineer. And so he's a very, what would you call it, clinical type of guy. Like it's very factual, logical sort of way.
Science-based.
So
yeah. And engineering-based too.
yes. So if anyone, I encourage anyone, just type his name and you'll see most recent sort of discussions he has. But you can go back many years and you get a theme as to how he ticks. But it's very factual based, and he does endeavour to predict trends or try and go where the concept of where the puck's moving to, not where the puck's at. So and I think where strategy has evolved today, if we look at, we're in 2025, that period of 2002 to 2020 was a real challenge for him. And I'm sure there was he tried a lot of different ways to not re-engineer, but it sort of make MicroStrategy to compete with the likes of whether it's Oracle or IBM or Microsoft. And he found it very difficult, and the board and the company found it very difficult to do so. And so he was really presented with, it was profitable. I think revenue was around 300 to 400 million a year, and he was making maybe net 10% or something along those lines. So there was cash. I think he sat on cash of about 400 or 500 million by the year 2020. But what he describes, and I love this quote, is it was like a slow dying death, because he was treading water, but that's what he was doing. His ability to compete in the capital markets was pretty non-existent. He wasn't able to get the cheapest capital like a Microsoft or Google, who'd come through and absolutely dominated. Now, and that's the nature, I suppose, of capital markets and I suppose the world that we live in. But he really was trying to find what could give him an edge. And it really wasn't until he came across Bitcoin in a more detailed way. I assume that was from late teens, like 2015, 2020, that he'd done a lot of research, noticed it hadn't sort of been a Ponzi, so to speak.
But he did brush it off initially, which is really interesting, because it wasn't until 2020, until the COVID dilemma, that he witnessed what was happening in the sort of Cantillon effect, where, hang on a minute, there's no one in the offices. There's a fantastic video with Natalie Brunel on Coin Stories, November 2024. I'm going to find it and I'll put it in the notes, because that was a really good one, how he describes really meticulously the problems and the confusion and the anger that he had towards the system.
Okay.
And so, no one was in buildings, and yet the infrastructure would double in price because interest rates went to zero. No one's working, but anyone who held assets, their wealth doubled. And he's sitting there losing all his staff who can work from home, that we're just getting poached by Microsoft, poached by Facebook, who could pay more. And he's this lowly sort of entrepreneurial, engineered, smart guy thinking that this isn't fair, the system's rigged. What am I going to do? And then he's like, I've got three options. I can die a slow death.
Yes.
I can sell the company, or whatever what comes next.
Yeah. I think added to your point as well is the cash he was sitting on. Like I said, it was probably around that 400 to 500 million, I believe, at the time, was eroding in its purchasing power, just because we saw that strong uptick in inflation, just because asset prices went so much higher, but also just, I suppose, the inflation that existed in day-to-day life, right? Whether it's, human inflation or it's inflation of goods. So he sort of, all that hard work that he'd built up, that Treasury position.
It's a fantastic point, because you're sitting on $500 million of cash, and he's like, that's right. The other option was, I can buy back my stock. I can pay it out as a dividend. Well, people don't invest in tech stocks to get dividends, generally speaking. Right. They want the growth.
And he had set out, again, reading up until the 1990s through to sort of 2000, there'd been really strong growth, but it essentially hit a wall, so to speak, on how does he keep moving forward in what he talks about is nearly an impossible game unless you're sitting at that.
Competing against Microsoft, IBM, and you've got this $500 million treasury. What are my options? Well, before COVID, I could buy this much property. Now the asset prices have doubled and I can buy half as much property.
Yep.
Like my purchasing power just got cut in half.
Yeah.
So that's now not an option.
Yeah. And I think you mentioned just offline earlier that his ability to predict trends is quite solid. Like his book that released, what was it, 2012?
Yeah, so this book here, the Mobile Wave by Michael Saylor, he's talking about, it's 2011 to 2012. He just is discussing how insane technology is with regards to iPads in particular, and these big technology trends, from grandma to toddlers all being obsessed with these iPads. And he put all his wealth into these big trends: Microsoft, Google, Apple, and 10x, 20x, 100x his wealth and his money. So he doesn't need money. He's rich, right? He could sell the business and go off and sail into the sunset. Chose not to do that. Yeah. But he's a big predictor of trends, and that's important because that's what's coming next.
Yeah.
So how did this business analytics company transform itself to becoming one of the best performing stocks post this, catastrophic demise and legal problems that it was having, down to 42 cents per share?
Yeah.
That has been the best performing stock.
Yeah, since pretty much, particularly pre-COVID, just if you take sort of that time frame. So, what's fascinating is the conviction. Like, I think this, and you'll see that in some of the, like, what has actually happened. So come 2020, clearly Michael Saylor presents to the board. Now he's got a strong position in the company, so I think he can move, the strategy of the company, so to speak. So he presents a board an opportunity, which he discovers around Bitcoin, which really there wasn't another treasury company publicly listed at that point.
But there were a lot of Bitcoiners. There were people that understood Bitcoin, big hodlers. Bitcoin price around 2020 was probably around 3,000, 4,000, 5,000, but it did shoot up post-COVID when that stimulus came in, just setting the scene of where Bitcoin was and what he was doing.
But what I think, using his engineering sort of mindset and the trends that he sort of looks for, and when he looks at what just transpired with COVID and just the amount of stimulus that was essentially printed, he basically went back and said, well, then what's the point of me absolutely working, me and my team, 7 days a week, trying to generate some cash when that cash is getting diluted? So there was a real, like you mentioned, I think it was a moment of, what's going on? How are we going to move forward if this is the playbook? And so he identified the importance to basically shift. And in his shift is that Bitcoin was an opportunity, that what he talks about is he was nervous that he identified it and he was worried that others were going to see it as well. And therefore they were going to start accumulating at a greater pace. So again, let's go back to just quickly refresh around Bitcoin. Bitcoin has true scarcity in that there are 21 million coins that will be, minted, so to speak, as in proof of work, through the way it's a mathematical problem, and we're at sort of 19.95 million now. So it's sort of still got a while to go. But in 2020, obviously supply, I think it might have been 95% of supply was mined and on market. So he saw an opportunity. And when he looked at money, it presented as from an engineering point, exactly what he was looking for in money. And that is that it had true scarcity, it was a bearer asset, it had all the elements that we spoke about last session: fungibility, the inability for someone to manipulate. It had existed for 10 years at that point in time, and he saw it as an opportunity. And, you know, his ability to then sort of pivot and really start that process, you know, it was evident in 2020, and 2020's purchases were, you know, quite significant. So he looked at all the cash he had, and he's in 2020 purchased, I think, 70,470 Bitcoin. Average price was just under $16,000 US. So it spent 1.1 billion. Just to reflect, the business itself was market capitalization, which is a multiple of its share price with its shares on issue, was only around $2 billion at that point of time. So this is a company that was valued at around 2 billion, really hadn't moved much in the preceding years.
And was slowly dying.
And
losing revenue.
Correct.
Yep.
And he saw that like being a real challenge. So that was his purchases. And I think stepping through year by year just on the purchases gives the ability to understand where we are today, and also present or set up a good discussion on what the future may look like and why it presents such a, I suppose, a real opportunity if you want to see it in that light. Again, not financial advice. So 2021, it continues on some purchases. 2021 was quite a buoyant year. I think we hit some highs, well, you know, some real peaks. So Michael Saylor purchases another, or MicroStrategy purchases 53,921 Bitcoin. This time he's having to spend 2.62 billion to do that. So the price on average he's paid is 48,608 per Bitcoin.
Yeah.
So just within 12 months, or less than 12 months, because he would have bought it over the year, he's paying 3 times the amount he's paid in the preceding year.
And still buying it.
So
now, he still sees value in it. He still understands the scarcity. This
correct.
is the nominal bias. It's $112,000. I missed it.
Yeah.
Not true.
Yeah.
Not true for any of these treasury companies. They don't care because they're arbitraging something different.
That's right. And I suppose the real challenge, if we look at it, is in 2021 we had a lot of buoyancy. We had, you know, share markets returning to all-time highs, and although we're going through COVID and sort of all the restrictions that came with it and the new world we're adapting to, there was such a flood of money from central banks and banks in general that it really inflated prices, asset prices, and I suppose the wealth effect, particularly those at the top end. So then when we had and we had really loose monetary policy, in other words, interest rates went to virtually zero and borrowing rates are sort of sat at around 2% to 3%. Well, that started to change in 2022, and we saw the quickest increase in the rate cycle in the history of central banking. So, and you see that in his purchases. So it was a lot harder to raise money. So in 2022, MicroStrategy's purchases were only 8,109 Bitcoin, spending 276 million. Average price was 34,000. So again, they were able to buy it cheaper, but the ability to raise money, because that's essentially how they were doing it in the first 2.5 years, 3 years, raise money was harder. So moving on to 2023, they returned to more stability in the lending rates, and they were able to, and they'd sat on some pretty good gains at that point, purchase another 56,650 Bitcoin, spend about $1 billion, average price similar to 2022 at around $33,500 US dollars. What becomes really interesting is the next 2 years, or the current year we're in 2024. MicroStrategy starts thinking bigger and broader. And this is that sort of trend type of vision that he looks out. And what I think has transpired is a platform that has really escalated the purchases. So in the years of 2024 and 25, which we're currently 3/4 of the way through, over 70% of Strategy's purchases have happened in these 2 years.
Why?
Well, his ability to tap into credit markets and issue equity has been its greatest. So, and we'll get into why that's been the case and what he's structured and set up. But he's purchased, in 2024, 257,250 Bitcoin, spending $21.9 billion. and an average price of 85,000 US. So clearly paying more than double the year before. We had a good run up. We had some issues with the FTX exchange blowing up. So we had dips in 2023. We sort of merged out of that. And Bitcoin rose, and he's purchasing at 85,000 or higher in some instances for an average price. And then this year as well, he's continued on the purchases. Already another 93,000 Bitcoin have been purchased at over $19 billion spent. Average price is over 100,000. So overall, MicroStrategy today is sitting on about 639,000 Bitcoin. That's 3% of the supply, or just over 3% of the supply. And it's cost him around just under 74,000 US dollars per coin. And I think that's important to just reflect on. The quantity of Bitcoin that is far greater than any other corporate treasury. I suspect it's far greater than any other private company that has. And the question is, what kind of moat does that provide him in time, right? And it provides him one now, and we're going to talk a bit about that shortly. But that to me is, to do that today, it would be near impossible without having significant cash behind you and driving the price.
You drive the price through the roof.
Yes.
There's always sellers. Levels. There's always sellers coming on, but you would drive that price up. There was a $2 billion company, and yet they've acquired $70 billion of something.
Correct.
Of Bitcoin. From $2 billion to $70 billion.
Yeah.
And now it's valued upwards of $90 billion, around 95, 99 billion. 1.5 net asset value of the Bitcoin.
Correct. So yeah, when you look at total enterprise value, which is the asset plus its business itself that it runs, which is a small component but it is still an operable business that is profitable and it does use to buy more Bitcoin.
It's important because it doesn't mean he has to borrow money to pay staff and to do whatever he's doing behind the scenes. That business can keep chugging along.
That's right.
And he can just hold the Bitcoin and then pay the debt and the obligations behind it.
Yeah, that's
that we'll get to later.
So just to put context, he pivoted in 2020, and his pivot was he was sitting at running a business worth about $2 billion. And in 2025 in September, so 5 years later, he's been able to generate and a market capitalization of the business is now 95 billion, got as high as I think about 110, 120 billion. And he's been included in the NASDAQ, just on the top 100 companies on the NASDAQ listing, and on the cusp of being included in the S&P 500, which is very significant as well. But
it's significant because it will drive passive income, passive flows, that funds will just buy it without caring about the valuation.
Yeah, and we're seeing that today as well. Some of the biggest funds like BlackRock and Vanguard, Fidelity are all in their passive funds. They have the NASDAQ and within that, MicroStrategy is a portion of that. So they're passively buying it, which supports not only his stock, but all the others proportionally, obviously, is weighting. But that growth in wealth creation is all backed by net assets. So if Bitcoin's valuation, which as of this morning is around 112,000 US dollars, it's about $73 billion ish of assets. His company is worth 1.5 that. The question is that fair value? And we'll probably get into a little bit of that, but that's something for people to consider, and particularly when you're comparing other companies.
So when you're comparing, just in investing in general, the subjectivity of investing, right? Like you might look at a price to earnings ratio, you might look at a Shiller ratio, which is the price to earnings of the market. And we're at the highest that we have been, something like 39 times, especially in America, the highest we have been since the dot-com bubble. So but things have changed. You can no longer buy a Warren Buffett, Ben Graham style of business buy it for, less than what the assets are and then strip it apart and then make money on that. Like, it just, investing has changed, and that's because of what you and I know is the underlying problems of the money underlying the whole system. It's created and perpetuated this problem growing more and more extravagant. So traditional finance sort of looks at it and goes, too expensive, too much debt, and they strike it out. However, understanding Bitcoin, you've got 1% of the world that understands Bitcoin.
Yeah.
Then you've got 1% of investors that understand MicroStrategy.
Yeah.
That's the arbitrage of asymmetrical bet that you're looking at with this particular opportunity.
Yeah, that's a good point. You're right. It's like, it's really important to have the fundamentals of Bitcoin. It's got to be understood and see how it's emerged in its future. And if that sits true, which it does for me
And me.
so again, and yourself, then, and it's not personal financial advice, then it enables you to understand what strategy are embarking on what they've done and what they're embarking on. And like I sort of mentioned, that 70% of Bitcoin purchases over the last couple of years, when it's at quite a high point, I think reflects two things on what Michael Saylor and strategy are doing. One is the conviction in where things will be in time, because he's not a seller of Bitcoin. He's made that very clear. And secondly, it's also his ability to develop products and look at the broader market on what's going on and seeing an opportunity to tap into some of that, the debt markets, credit markets, and raise equity where he sees suitable to continue on this journey. But it will be harder because the edge that he saw 5 years ago at 15,000, we don't know if it'll ever be repeated. And you know, we're not seeing those pullbacks in Bitcoin's price. So therefore, you are going to have a whole lot more fiat currency in US dollars to try and accumulate, no matter who you are. So,
And I think that's an interesting point in that we're seeing Bitcoin price and Bitcoin as an asset now. The ETFs coming through in 2024, a government in America that is supportive of that industry, and you're getting lots of individuals supporting these big dumping and selling of long-term holders or hodlers, as I just noticed your shirt. So you're seeing it really supported, and that's why partly why we're not getting these big pullbacks, because it's becoming recognized and more understood and financialized as an asset, because that's what Wall Street does. They financialize everything. That's why they don't have manufacturing, and that's their problem with China. Is they basically got, as Luke Groman says, they've got these F-45 biggest paperweights on the planet because they don't have the rare earths to use them. So they've hollowed their manufacturing base out because they financialize their economy. Bitcoin is now being financialized through Wall Street. So you can either look at it and say it's a Ponzi and just dismiss it, or you go, maybe there's something more to it, regardless of what I personally think or what other people are saying. Wall Street's clearly adopting it, and there's something like 70 to 100 Bitcoin treasury companies now. 180 Bitcoin treasury companies, as well as private companies and public companies who are owning Bitcoin.
And I think that's important to just reflect on. So the last 12 months, we've seen quite whether it's a theme and whether it's, you know,
whether it's like a meme and sort of like it'll come out and die and maybe not come back.
I actually think, if having ran some, you know, small businesses, when you look at, if you have cash, you want your cash to hold its purchasing power. And that is really important.
That's all you want from it.
Absolutely. So you work so hard, you want it to maintain. And if that is a philosophy and we don't recognize what inflation has done and doing and what it's likely to do, because the economics now are, we're so much in debt that we might go into some yield curve control, bringing rates down. But in bringing rates down, we're going to run inflation hot. What does hot mean? Well, it could be anything from 3, 4, 6, 8% at times. That's an erosion of your purchasing power. And so how do you maintain that? I think for business and as individuals, it's a real important question, because what we will continue to see is asset price increases. maybe not as drastically as what we saw in 2020, 21, etc. But we will see them. So how do you keep up? And how do your children, how do your friends, how do you maintain your way of life, but also be able to purchase a property or something along those lines? So it's a real challenge, and Bitcoin provides an outlet like that. And I think Treasury companies, many of them have seen that, and some of them have jumped on for the thing. There's no doubt, and we'll see that play out. But what we're seeing, and what we're keen to discuss with around strategies, they've built such a collateral base, and if we look at collateral is around the foundation on what you can do so much with, it's pretty special. And you've got to remember the compound annual growth rate over the last 10 years of Bitcoin is 60% a year. So even if we dial that down by half, a 30% compound growth rate forward-looking 10 years puts Bitcoin at well over $1 million a coin, US. So even if you say that a 30%, even halve it again if you like.
Yeah, be conservative.
Be conservative and go a 15% gives Michael Saylor strategy a valuation on his Bitcoin at, 6 times the stack it is today. So that's growth in itself. So if you can grow your earnings, because we've got to remember that as of January 1st this year in America, the FASB rule changes allow balance sheets to be mark to market, I believe it's called, where if you made money on your assets, they go into your earnings, and that's how your earnings sort of get declared each quarter. So if he's growing his earnings at that 15% rate, let alone at the 60% rate, which is what we've seen, what do you put a premium? What valuation do you put on that? And that's something that, firstly, I don't think he's been even, analysts are even really assessing, let alone understanding, because we're so early. Like you mentioned, we've got 1% or a very small percent who understand Bitcoin, and then a small percentage of those who really are seeing what Michael Saylor and strategy are doing and embarking on. So, and that's without talking about the preferred shares or, additional purchases or anything else that he might venture into. But, and that's what sort of I see it and say, well, we shouldn't dismiss where this could end up. And again, look at the evolution of the top 20 stocks on the stock market over the last century, and they evolve regularly. Nvidia wasn't where they are today as number one 5 years ago. And 10 years ago, it wasn't Apple and Microsoft. So, we used to have Exxon and was it General Electric were dominant. We've seen that evolution, and I don't think that will change. Now, whether strategy is one of those or part of that group, time will tell. But, if we are moving to a digital age, and one thing that hasn't been disrupted is these capital markets and credit markets, because they just continue to live in this mindset of cash flow. We see disruption, and that's effective, then they are in a very strong position. And if you look at Bitcoin being the base layer of money with its value going up, per annum, something special could be emerging. And I think it's a really good thing for humanity, let alone for those who are holders of strategy shares or Bitcoin itself. So,
all we're trying to do is predict as investors. We want to hold our purchasing power, but not only that, we want to grow our wealth over time.
Yes.
That's what we're looking at it. That's what we're looking at things. And when you were in the early 1900s and the railways and the railroads came to fruition, count the rail carts, that would be the predictor of the economy. Therefore, I will invest in this. All you're doing is following the trend and predicting the trend before it gets there.
Yeah.
Is there anything else you want to touch on before we get into the debt side of MicroStrategy and the preferreds and how that
spot on.
works? Is there anything else you want to bring up?
No, I think
we've missed.
We've covered. I think the essentials. Yeah.
Okay, so I want to give you an analogy of the problem that we have in debt markets and in the economy as an aging population in the West. If you imagine a tennis ball, you drop it from a meter high, it bounces, it never gets to that apex again. It's a slowly depreciating curve right? And then it bounces again, it gets halfway again, bounces again, halfway again. And then it starts to dribble and stops rolling, and then it will roll. This is the interest rate market. This is how I see it. Since the removal from the gold standard, 1971, we've had a decreasing but bouncing interest rate that has gone up, and it's just coming to the end of that dribbling phase where in COVID we saw interest rates 0%. We saw negative interest rates in Europe.
Yeah.
We saw banks having to introduce technology that allowed them to have negative interest rates, which means basically I'm going to pay you to borrow money. I'm going to pay you to take risk because, we could talk for an hour about debt. So let's just assume we know a few things about debt already. But World War II, we had the baby boomer generation. That generation is called that for the reason of increasing fertility to repopulate the West after the World War II, because that was the most catastrophic end to humanity. That generation is now coming to retirement age. Fertility has been lowered in the lead up and because of broken money and underlying systems and a whole various number of other facets. But now, you used to be able to just put $1 million into a bond, into a treasury, into a bond market maker overnight rate where you would get 10%, 9%, 8%, 12%. You would get good return on that money. So a retiree, plus you didn't have as much inflation. So a retiree was able to put $1 million in a place overnight and they get 10% return for the year. That would give them a fixed income of $100,000 to live upon.
Yeah, well, I think that point there is you had a declining interest rate environment from the 1970s. It sort of picked up in the 80s, but then we sort of slow decline. So bonds became just a winner. Because as rates fall, it's inverse, right? So
because you've held them previously, and then 2 years later they're half as much. That one you bought 2 years ago is more valuable.
Yeah, and you're getting a coupon as well. So you've got that 60-40 portfolio that's been spoken about is all beneficial whilst that's occurring. Hence why they've been the last 18 months, 2 years when interest rates started rising, they've been absolutely one of the worst. And the question is, what does the future look like there? Because in that process, what the America did was hollow out their manufacturing base, whether it's a car manufacturing or anything that they manufacture. So they've offshored through China and through Asia particularly so much manufacturing to get this lifestyle, and the baby boomers being the biggest beneficiaries. They've then, what have they done? They financialized their housing markets and financials themselves. So, they've been the biggest beneficiary of this scenario. And today, the younger generation say, what does that mean for me? Because I have nothing, and how am I going to make it?
There's a lot there. So to unpack what we've just said, go away and do 5, 10, 100 hours research into that problem to understand now that we've got to the end of that cycle where interest rates can't go any lower. They are at the bottom. And so what happens next? So how does strategy influence the debt markets? How do they access it? What are they doing that's an arbitrage that's different? How are they solving this problem?
Just go back to the US. There's so much debt in the system, and in Australia we have private debt. So to purchase our asset of a home, because we want to live somewhere, it is so expensive as a ratio of your income or your dual income with your partner. It's like 10x or 12x. We've spoken about that last time, I remember. So in America, the federal government debt and state debts are so significant that one of the biggest expenses is interest on the debt. So it's in the top 2 or 3, right? And when it's that high, and it's one of the things they can, or they're looking to, what they call is yield curve, control how much they pay for that, because they don't want to cut services to Medicare or Medicaid, which is their health and insurance systems. And they're not going to reduce defense because it's such a big industry for them in exporting. Then the one they can influence, and we're going to see that. I think there was an article in the last 7 days that come out around one of the third, so the two mandates the Federal Reserve has is full employment and inflation. So the third one, it's being looked at with Trump administration next year, and when he appoints his, the successor to Powell, is a third mandate of yield curve control, which is essentially driving down the rates to a level that, with the 37 trillion of debt, if you halve that rate or less than that, then the debt is no longer $1.1 trillion a year. It's only $500 billion. And that's still a lot of money.
You've saved $600 billion right there. So Doge comes in, tries to save money.
Yeah.
We're going to wipe $2 trillion off the cost. Figured out they can only wipe 150 billion.
Yeah.
And then with this idea, the manipulation of the system, they've been 3 or 4 times more effective.
Now, the risk of that is you're not allowing markets to price true risk, credit risk.
Yeah.
And that is a dangerous game to play, because in order to do that, they're going to have to print a lot of money to keep that control of the interest rates at those levels, because who's going to be buying those bonds or treasuries? Because most China isn't buying them anymore.
They're selling treasuries.
That's right. So you've got, so that'll be inflationary. So hence going back to the comment a little bit earlier.
And why would the boomers buy them if they're, why would retirees buy them if they're so low and the 60-40 portfolio doesn't work anymore?
Correct.
I want to reiterate one point without sounding like a conspiracy theorist, but I think it's relevant. The other two mandates, full employment, that definition has changed over the time of to what full employment is.
Constitutes, yeah.
And then you've also got government jobs propping up that sector of full employment, which you are going to speak about later. Then you've got inflation being stable. They want it to be stable. Now, that doesn't mean no inflation. That means 2 to 3%. They want inflation. And not only that, but another episode we've talked about how these numbers and these statistics of inflation are manipulated, and they're not true asset inflation. They're not even true consumer price index inflation. They're manipulated. So the employment market's manipulated, but that's what's affecting interest rates. The inflation rates are manipulated, but that's what's affecting interest rates. And now we've got yield curve control, which is by definition a government manipulating a free market and propping up and selling down the bond cost so that the interest rate payment is less than what it naturally would be in a free market.
That's right.
The whole thing, without sounding like a conspiracy theorist, it doesn't sound right to me just based on that.
Yeah, I mean, for those, Jack Mallers is someone I the last couple of weeks, he's come out with some amazing data and content on just the position of the federal government. And it is, I think he calls it, it's like survival mode, that just in August, I think the data came out that, they've generated good receipts. I think it was something like 360 billion, but their expenditure was 640 billion. So the deficit just for the month was over 300 billion in the US federal government. If you annualize that, that's well over $3 trillion as a deficit. So they've got to start influencing this in some way, and the one that they can is bringing down that cost of the debt, because their intention is not to stop the deficits. The intention is to continue to run deficits, but if they can they control the cost of the debt, they want to run the economy hotter than the cost. So the inflation rate, they want to run it hotter than that. So in other words, grow your way out of it, which is what they're pivoted to, the Trump, and that's going to be a challenge, right? But that's what he's inherited, and the administration, and they're going to try their best. And I'm sure, crypto, Bitcoin can play a part in that. But yeah, that's the sort of landscape. That debt scenario really sits at what's unfolding at the moment.
That's modern economics and MMT, and you've got a third of the assets being houses, a third being stocks, and a third being debt. So strategy, what are they doing? So they've got a few different products. How have strategy accessed debt markets? How have they accumulated all this Bitcoin? What strategies have they implemented in order to do this?
Yeah. I suppose that any company's got 3 options, but particularly publicly, and this is why they go onto the public markets, is they can issue more shares, and Strategy have done a fair bit of that. And with those shares, they use that money to buy Bitcoin.
So a capital raise is how we'd view it here in Australia.
Yeah,
Yep.
that's right.
Is it the same thing, the way that they do it in America, a capital raise?
Pretty much. It might be slightly different, but the nature of what it is the
Yeah.
same. And they would preempt that that's their intention to do it, so they wouldn't need to pause their trading or anything like that. I think here it's quite strict on how we go about it. It's from my sort of seeing companies who do capital raises. The other couple of ways is through convertible notes, and most recent one is preferred debt. So the convertible notes is where they started. So each one of those at different points of time are attractive for Strategy in order to buy Bitcoin, and they'll use them accordingly on which one suits them the most. And as shareholders, that's what their intention is. So, because they're trying to maximize sats per share or value for the shareholder. So there's some key measures that they look at when making these decisions. The preferred share or convertible notes, outside the issue of more shares, the convertible notes was something about 12, 18 months ago, got issued. They're all basically, they issued well below. So currently the share price is around $330 US dollars. They issued them well below that when it was trading well below that. So all these convertible notes are in the money. So they're all going to convert to shares.
And so a convertible note is, if I'm correct here, you're taking someone's money,
yes,
and you're buying Bitcoin with it, and then you're saying, if we get to $400 per share or $300 per share, then we will convert that into equity, into shares for you, and then you will get those shares.
Yeah. Well, you will take that option up.
You take the option, and then that converts to shares, which is dilution for the shareholder. It means that the shares on issue are growing.
Yes.
The market cap will stay the same unless that affects the share price.
Yes.
Yeah, just to get the intricacies, because they're important. That's why we're here.
Yeah, I suppose what the time and place they did that, the share price was below $100 a share. So they issued these convertible notes at a strike price of 100. So all these convertible notes are well and truly in the money. So they're never going to have to pay out what they were given. Does that make sense? So with that money at that time, they've bought, I assume it's back in 2 years ago when Bitcoin was...
Yeah, because you're buying it for a third of the price, basically. You're getting Bitcoin...
Well, that's how it's eventuated. You didn't know that at the time, remember?
Right.
Yeah, and Bitcoin's price accordingly has gone up from, so let's say, around 60,000 US. It's sort of nearly doubled, or even might have been at 40,000, 45,000 at the time. So it's context on both fronts. So they received money to buy Bitcoin at that point of time, which is around that $40,000, $50,000 mark. And then in turn, the holders or those who provided the money have the ability to convert at a strike price of 100. Now they're going to convert because it's $330. So why wouldn't you, right?
Yeah.
So that's, I think that constituted about $8.2 billion of the $14.7 billion that they currently have. In convertible notes and preferred. So essentially 8.2 billion, that's never going to be due. So they're going to convert into shares. So they don't have to come up with that money at all.
Yeah, it's not debt.
That's correct.
But if it didn't,
then they would
have to pay the debt.
That's right.
And then they would raise capital to pay the debt.
That's correct. So if you listen to what's happening today is that every year, so as of this year, they've raised $19.2 billion through either equity. And so the intention is as they raise that money, the portion that's required to pay the dividends or pay out the debt, if they had to in this case, comes from that. So they do have some cash flow from their underlying business, but again, they'll make decisions on how they want to use that, whether they purchase more Bitcoin or they leverage it. So essentially, Strategy has become a leverage play on Bitcoin. So if you're thinking around Bitcoin is something I want to hold as an underlying asset, and you see the value of it over time and its growing adoption, Strategy has basically said, well, we're turbocharged. A Bitcoin Treasury company in Bitcoin. So we will accumulate as much as we can because we see the scarcity and the value of it, and that's what essentially they've done. The third way they've looked to, and this is the most, I'd call it innovative and disruptive, is through preferred option. And this is they've basically created 4 separate entities that are listed on the Nasdaq that basically aim to appeal to the debt markets in different ways. And this started in the last year, and the most recent one, STRC, only just got released in July. And they appeal to different segments of the markets because whether you're a pension fund or an insurance company, you have different mandates on how you can apply the money, or fixed interest if you're at a different stage of your life. So what strategy has done is sat back and had a look at, well, how big is this pool of money? And it's big. It's in the trillions of dollars. And so they're basically aiming to provide a better solution or another option for these monies that are providing greater yield. Now, let's just go back and reflect back on, if yields are falling because you've got yield curve control in the US. So in other words, the interest rate you're receiving as a pension fund or insurance company drop to 2, 3, 4% or less, then how do you get a return for your fund? So
if the interest rate's 4% now in America, and if they're doing what they're saying they're going to do, and it gets to 2.5%, 3%
or less,
how are you going to invest your money?
How are those investor monies going to get a return? When they're so. He's basically, or Strategy has developed these 4 products.
How are they going to beat the hurdle rate?
That's right. So let's go through them. So they started, their first product they released was STRK. And again, these are all listed entities. So although they sit Strategy are the owners of the entities, STRK was the first one. I think it was early this year or late last year that got listed. It was listed at around $80 per share. The intention around STRK was it provides some Bitcoin exposure on the upside, but not the volatility on the downside. So in other words, it has a conversion rate. So every STRK share you have will convert at 1/10 to a strategy share at a given point of time. In combination with that, you receive an 8% yield paid quarterly, and it sits in the middle of the capital stack. In other words, if Strategy was liquidated, it would sit, I think, 3rd or 4th in the order of
and they pay them out from the top. If it become bankrupt, delisted, whatever.
Yes.
Then they would be 4th or 5th in line, or middle of the range to get paid out.
Correct.
So that's a risk. I guess you're assessing the risk there.
Yeah, and again, remember that Strategy is a play on Bitcoin. So if you're not familiar with Bitcoin, I encourage you to sort of understand it.
You shouldn't be Would you suggest it would be inappropriate to own Strategy if you didn't understand Bitcoin?
Yeah, then you really correct, because it's become a Bitcoin Treasury company who now is tapping in traditional credit markets to access money to buy more Bitcoin. So Bitcoin sits at the foundational level, and I'm sure will play a significant role into the future, just because of its sheer weight. It will, if its growth rate continues as like it has. So STRK, I think they raised around 1.34 billion in February to launch this product. It's gone pretty well. I think it got as high as $110. So it tends to have a correlation with Strategy, the share price. So as that rises, you'll see STRK rise, not proportionally, but in that way. But from an income point, it provides real regular income, 8% per annum, paid quarterly. So you get 2% per quarter. And it's in perpetuity as well. So in other words, this isn't reset every year. It is if you buy it today, it will be paid, and so it's got a long duration.
Forever.
Yes,
yeah.
Correct. So that was a good outcome, and with that money, they bought Bitcoin, right? So the second product they released was STRF. Now, STRF, they raised 1.13 billion, and this occurred the following month in March. And if you look at where it sits on, it's the top of the stack of basically, if they were to be liquidated, they would be the first to be paid outside the convertible notes.
So much lower risk to the other ones?
Correct. So it's been built as investment grade. So when you look at a AAA rating, it's been built to compete in that market. And so...
is that accessing a different type of money? Different borrowing?
That's correct.
Yeah.
So it has a dividend yield initially of 10% or $10 per year. It's now trading at 111. Initially it was traded, I think it came on market at around, again, $85. So now trading at 111. So it's actually performed quite well because it's people...
It's desirable.
It's desirable.
The market's operating as it should.
Okay, listen to some of these. So not only it sits at the top of the stack behind the convertible notes on the basis that in their prospectus, it's no other preferred can be written above it. So that's one. It's payable, so it's $10 payable, which at the time was greater than 10%. And if one of the payments per quarter is missed, it's cumulative. And then there are penalties for strategy if they don't pay that after the second quarter, I believe. So you've got these rules that are in play that make it pretty solid.
And how do they pay it? How do
So
they pay the
again,
dividend?
all these payments are through, essentially the plan is to go back, raise more money through share issuance, whether that's $1 billion or $10 billion, whatever they raise through more share issuance, then they grab about 600 million of that to pay these annual dividends. So of these total preferred shares we're talking about, they've actually raised just over $6 billion for these four products. So at around about that 10% yield that each of them on average have, it's about 600 million a year they need to have to pay out.
Right.
So what they're saying is they'll raise shares. So Saylor says through share issuance, they will put that money aside and that's how they'll pay them out. And with the remainder of the money they might raise, they'll buy Bitcoin with it. And with any more transfers that they might, go to market with through these preferred products, they will in turn, adjust accordingly. They'll buy the Bitcoin, but also, put more money aside for the funding requirements. So STRF sits at the top of the stack, and again, investment grade. One of the really key things around these four products that is really interesting is none of them have been rated. So Moody's or who are the other rating agency, the key ones out there?
Fannie Mae and Freddie
Mac. Yeah. They need products to be rated in order for them to buy them. So the fact they're not rated, there's so much capital that
it's
isn't
still
at their disposal
accessible.
Yet. Correct.
Right.
The moment they get rated, and it is an item that Michael Saylor and the management team are working with the credit ratings to get them rated, particularly STRF as an example. The moment they're rated, they'll then access pools of money that people will be interested in, because what you'll notice with each one of these products, their yield is 400 to 500 basis points or 4 to 5% greater than what's on offer today. So in other words, STRF is investment grade. Investment grade currently pays anywhere from 4% on a 10-year Treasury or 5% or 6% on a corporate like an Apple or something like that. This is paying or was paying 10%. Now it's about 8.9% because of the increase in price of it. It's still around 400 plus basis points greater than what's on offer.
Yeah.
That's appealing, and yet it sits at the top of the stack.
Yeah.
If something were to go wrong, combine that with its collateral. So let's go back and understand how secure is this. They're sitting on Bitcoin that's worth anywhere from $70 to $75 billion as an asset. They've borrowed equivalent in these preferreds of $6 billion.
Nothing.
They're collateralized. Exactly right. More than 10x.
Yeah.
So each of the products are collateralized slightly differently, but overall they're collateralized significantly higher. And we'll talk a little bit about the Commonwealth Bank of Australia and how is that collateralized. But it's significant, and it is a disruption to the credit markets or to the financial markets that has not occurred before.
And it's wildly misunderstood.
Yeah, and I suppose the question is, and my uncle had this question because he's looking to deploy some money as an older gentleman into something that pays a good steady income stream. How can they do this? Well, they can do this because what Michael Saylor and Strategy are basically banking on is the 10% or 8% that they issue you on the two products we just spoke about, STRK and STRF. They will then use it for an asset that's growing at 60% compound annual growth rate in the past 10 years, or if we say assume a 30%, which is what his estimates are for the next 20 years. So you've got this, what he believes is an arbitrage play, let alone the other value he might extract from it. So that's how he it's justified around the offering. Right, and it's got a collateral position far greater than anything else on the market, whether it being corporate or whether it being government, etc.
There's a healthy debate that what Bitcoin did between Lynn Alden and then someone who described these particular products as Ponzi-like because they're paying a reliable dividend. We're not going to go into that part of it. If you want to listen to that, then do that.
Yeah,
we've got other stuff that we want to get to and compare it to the Commonwealth Bank.
Spot on. So the third product that was released in June this year was STRD. STRD appeals to the lower side of the debt markets. In other words, some people put, label them junk bonds or triple B bonds, or at the lower end of the stack. These tend to have to pay higher yields to attract the money, whether it's in a company trying to get some additional finance. So the appeal here is, so this STRD, they raised $1.21 billion in June, listed it as around about an $80 price. It's trading around that price now, I think a little bit under that. And its current yield is 12.7%. So an investor can go in and buy STRD, getting a 12.7% yield on the basis of buying STRD on the current price. The difference with that and STRF, there's a couple of key things. It sits on the lower end of the stack. The dividend is not guaranteed, and it's non-cumulative if they see fit.
So they might choose to postpone it or skip it.
And there's no penalties associated with it. Now, the probability of them not paying it is quite low because the monies that they've raised is only $1.2 billion. So essentially, if you look at... what's that? 120 million per year
annually.
Yeah, I mean, it's a small amount of money. So, but that is if things turn hairy, then that's an option for the management to decide. Yeah. So that's STRD, and that's a big pool of money that sits to be accessed. Final one, which was in July, really interesting one, STRC. So it sits just under STRF, so it's higher on the stack on if strategy was to be liquidated, how that you would get paid out. So that's a tick on a short-term basis. Strategy was able to raise $2.8 billion. It's the biggest public listing on the NASDAQ so far this year. So they've listed this entity, STRC, for $2.8 billion, offering a $10 dividend, which is calculated monthly. So it's aimed to appeal to, so the $10 isn't guaranteed every month, but it's calculated every month, and it appeals to the short term. So the money you might have in a short-term cash account or, in an interest-bearing account. Again, when you look at those accounts, they're generally paying anywhere from, 0.25 an interest rate up to maybe 4 if you're lucky. Yeah. So the spread here, and it's for people who need their money, in the short term. So you might be in a transition, or you might want to purchase a car in time, or whatever it might be, an asset. So you want to park it somewhere. The price stability of STRC since listing in the 30th of July, so that's 7-8 weeks now, it sits at around $95, $96, $97. It's, I think, trading around $97, $98 now. It basically trades at a very steady pace. So the erosion of the price is really negligible. So you're getting close to, in fact, today you're getting over 10% because it's a $10 dividend at $97. So you're
Right.
getting 10.2, 10.3. So again, appealing to a different segment of the market. And I think it constitutes several $1 trillion. So, yeah.
Right.
So just to go back on the four products that we've sort of covered, they are all debt markets that currently exist in the US economy. And if we start with STRK, it's appealing to, or an equity, it's appealing to a total addressable market of around 140 trillion, being the S&P companies listed in there, the NASDAQ. So people who invest into those areas would be interested in something like STRK because it's got the upside of like a stock rising plus the yield. Commercial real estate from a yield, which is a $4.7 trillion market, as well as someone like a Bitcoin investor who's looking for some yield, which historically has just been growth orientated. And that's $2.3 trillion. So you've got a really big total addressable market that will come across this upon it being graded, is my view. If we move to STRF, their total addressable market is around 40 trillion, comprising of long-term treasuries, mortgage-backed securities, which is 9 trillion, and then investment-grade bonds, as well as government bonds, which are more local or state municipal bonds at 4.2 trillion. So again, these are carrying these yield differences are huge, as in 400 to 500 basis points you're getting through investing into these products compared to what you have. And when you also overlay the liquidity of each of these, it's actually up to 50 to 100 times more liquid. So some of the products, if you were investing into a corporate bond, liquidity can be a major issue in getting in and out without sort of sinking the price, because they're not heavily traded because they don't raise a lot of money. When we look at how all four products are behaving, you're able to, they're trading at around 50 to 100 times plus liquidity of what they're comparative to.
It's not speculators getting in these products either. The speculators be more involved in MSTR, but they're not going to be involved in these dividend yield paying operations.
That's right. Yeah. These are all appealing to income orientated people who, you're really protecting
retirees.
Yeah, that's right.
And people want a return on their money that's going to outpace inflation.
Yeah. And you can see it if you were someone in your, just retired, but you've got sort of, 65, 70, but you've got 20, 25 years, you might have some STRK because you want a bit of upside of Bitcoin.
Yeah.
But you still want some good income. So you might have a couple of the other products or you want the security of your capital to maintain. So you put the rest in STRF. So, it appeals to different segments at different parts of their life. If you're later on in stage, you might just go STRF. If you're someone a little bit younger, you might look at STRD because you're attracted by the high yield. I mean, getting a 12.7% yield is like a share market return on average over sort of 10 years. And you got something that's been presented.
It's pretty hard to argue against if you understand and you have conviction in Michael Saylor, MSTR, and the underlying treasury of Bitcoin.
Yeah. So we'll just jump to
STRD.
STRD is a smaller total addressable market at around 2 trillion. Again, just appealing to high yield corporate bonds or, like we mentioned, junk bonds. So that's sort of the market. But again, it fulfills a need, again, paying far greater than the 7 or 8% that's on offer at currently, and does sit junior in the stack as well as in if it was paid out. And finally, you got STRC, which is appealing to a $30 trillion total addressable market. Now, this is really significant because many of us always have some money tied up in, a bank account that really is just available for us. So if we don't need something for periods of time, like 1, 3, 5, 6, months or even a year, as opposed to leaving it where it's being eroded on its purchasing power in a bank account, you can put it into something like STRC, which, there's about $18 trillion in America alone that sits in these bank accounts earning really minimal, from anywhere from, like we mentioned, 0 to sort of 3 or 4% if they're lucky. And this is also around money markets as well. Money market funds are 7.4 trillion. So they're getting a real suboptimal return comparative to STRC at a $10 dividend per year, which currently is costing you $97, $98 as of this morning. And then you've got short-term treasuries it's appealing to, as well as commercial bills as well. So the total addressable market for that segment is around 30 trillion. So when you think about that, they're only tapped in STRC's case, 2.8 billion. In time, as understanding and education comes through, and these get graded, and/or MSTR gets included into the S&P index, so it gets a lot more eyes across it.
Yeah,
you can see these products growing in relevance, and who knows what kind of monies they can raise and what will happen with their Bitcoin purchases.
Yeah, because they've also got the opportunity to use that Bitcoin as a potential to whatever they're going to do with that, right? Like the market's forward looking, and what is that going to turn into? Is it going to be a bank? Is it going to be used for lightning rails and receiving a yield upon its own?
That's right.
And then all of a sudden, oh, hang on a minute, we don't actually need to even issue any more debt.
Correct.
Because we have it all. It just plays out.
The
now.
Optionality is phenomenal. I mean, they can use the Bitcoin they have with derivatives to earn income, to pay for the preferreds that they're offering. I mean, that's another option for them. But again, if we go back to what's occurring in the broader economy around, yield hungry pension funds, insurances will look at these products at a given point of time. And I think us, as if we want to call ourselves individual investors, have a bit of an opportunity around, accessing these at the moment and, getting a 10+% yield or thereabouts. As they get more understood and they get re-rated or they get rated, I think it'll appeal to many segments of the economic, community. And it's
one slight detour before we go into comparing against Commonwealth Bank.
Yeah.
Didn't Allianz or an insurance company participate in one of the first of these products? A European.
I didn't look into. I haven't delved that deep.
Okay, yeah. Because my understanding was, and this is why our premiums of paying home and car insurance are affected. And every year we're like, why is it up 20%, 30%, 40%? What the hell's going on? And the reason is because these insurance companies are having to compete with. They take the premiums on board. They're going to have to compete with inflation. If we're having to pay out something like a house is now costing 20% more to replace from a flood, we have to make more money on our underlying asset or and charge a greater premium for the person purchasing home insurance. And so that's why they're looking at these bonds. They're looking at this 3 to 4% and what's happened in the last 5 years, where they've purchased these things because they have to put the money somewhere, and the money's gone backwards. That affects the consumer.
Yeah, and it takes, again, these preferreds take some volatility out, so that they don't operate one-to-one with either strategy or Bitcoin. So they operate less volatile. They can purchase some. For those who can purchase the underlying Bitcoin, I mean, there will be some that do that in time. And then strategy itself, again, a lot of particularly funds globally have got exposure to Bitcoin via strategy, whether it's the Norwegian fund or, any major pension funds. But these are products that, like you said, that's a really good example around replacement costs. And so then how do they, as opposed to issuing or the premium going up by 20%, they're able to offset some of this or be able to finance this. And this is a new pool that hasn't existed, and it is disruptive in a positive way. I mean, underlying, really, we need to question, why do we have inflation in the first place?
Yeah.
When as a society we just get smarter on how we function and how we do things. So life should actually become cheaper, but our debt situation really
it's complicated things. And for this insurance company, the rules around them means they can't buy a Bitcoin. So that's why they're looking at products like this. It's a fit for purpose need.
Correct.
It actually suits both entities really well.
Yeah.
And that's sort of the underlying driver that I think will be the catalyst for more and more adoption when a business has to survive. If the other insurance companies' premiums keep going up, and Allianz, it could be another company, but I think it's Allianz. If they're able to produce a lower premium, guess what?
That's right.
They're taking all the customers and they will prosper.
Yeah.
That's an ability for a free market to actually operate.
100%.
All right.
Point.
Now's the fun bit.
All right.
Because I haven't looked at CBA as a share. I halfway through this book, Banking Bad, and I turned it off. It was about all the information that came to light through the Royal Commission up to 2019 and all the things that were happening through the 70s and 80s. A lot of information there. I turned off halfway through the book because I'm like, all right, I get it. It's a stitch up and there's been an enormous history towards banks. But if we're just looking at CBA as an investment that was spun off by the government, now it's a publicly listed entity. You can buy it. Shares are like $160 per share, and the thing just keeps going up.
Okay. So I think so. We'll tie strategy into Commonwealth Bank at the end.
Please. Okay.
It's not a direct comparative because strategy is not a bank, but it's issuing credit, and its valuation can be comparative. Like I actually think it should be considered. Like when you putting the two together, it's interesting to look at what we're talking about here. So let's be, I suppose, frank that the Commonwealth Bank, as the other three major banks, being Westpac, ANZ and NAB, pretty much a government guaranteed. They're too big to fail, right? So if we just put that out there, the consequences of them failing are so significant that the probability is virtually nearly zero, right? So we just got to bear that in mind, that as much as we're going to be talking about a valuation that's so much higher comparative to international standards, let alone local, there's an
intangible prop there that gives you that security as an investment, knowing that it will be propped up no matter what.
Correct. So if we go into fundamental, Commonwealth Bank is around about 275 billion Australian dollars. Its earnings per share around $6 a share. They're up modestly around 5% over the last financial year, just ended June 30, 2025. And as a consequence, on $165 or 100, their earnings per share is sitting at around 26, 27.
For a non-growth company,
because
there's not that much growth left in, but it's at the top of the sort of S-curve adoptions, at the top of the peak. Is that why that valuation is high?
Well, I suppose traditional valuations on all the banks combined in Australia is around 16 to 18. So firstly, it's sitting much higher than that. And then we go then comparing to the US banks, major banks, they're sitting in the, sort of low teens, sometimes even high single digits.
Right.
So now there's 8 to 10 or 10 to 15. So you've got this, pretty much 50 to 80% valuation on the share price. It's higher of the
premium
compared to a Citibank or Citigroup or, So why is that the case? When we look at what actually, like to your point, the growth there is pretty much underpinned by the housing market. So, they require the housing market continue to rise, which means more loans get written at a higher price for them to grow their earnings. Interest margin is another piece. Obviously, as deposits come in, they earn some money on the spread there. But it's the housing market and some business lending that they generate most of their income from. And even over the past year, the provisions have had to increase by about 4% to allow for more bad debt. It's nothing ridiculous. What I find fascinating is when we talk about strategy being collateralized at on their preferreds at 10 or 12 to 1. So every dollar of debt, they've got $12
of assets.
Yeah. So in other words, you could get an 80% fall and still they won't be an issue. We've actually got the reverse in the Commonwealth Bank. So the capital ratio, which APRA set, so 10.25, Commonwealth Bank are sitting at 12.3%, so well over the 10.25. So the 12.3 reflects a percentage of their assets they need to fund through their common equity. So what that means is if 12.3% is how Commonwealth Bank sit, that means that 87.7% is being funded through debt.
So the 12% is the assets, like is the cash, and then the 87% is household debt, business debt that they've issued to people.
Correct. And another way to understand this is if there was an asset price fall of 12.3%, you would have assets and liabilities matching up. And if it fell lower than that, then you would have your liabilities greater than your asset base.
Which means
insolvency.
You're done, right?
Yeah. So unless you found ways to service that debt, which they will do, and it will be supported,
because they'll just print it.
Correct. It'll be backed. So you've got a leveraged position that is from a banking. It's worked. That's what we've done for decades, right? So I don't see that, but it's good to actually just take a bit of time to understand. Okay, how does the Commonwealth Bank make its money? Supposedly, yes, it's meeting the prudential or APRA's requirements, but it's quite fragile. So we're seeing in Canada and in New Zealand, house prices fall by 20%. Now, I'm not suggesting.
Have we really?
Yeah, check the data. It's we're seeing that transpire the last year or so.
Yeah.
So whether that flows into our market or not, I don't know. I'm not making a predictor on that, but it just shows how fragile we would be if that occurred, or Commonwealth Bank would be. But it also would have ramifications for general society, because I'm sure lending would be a lot tighter, rates would be a lot higher. So you'd see a real, tightening of the cycle.
A slowdown of the credit, which is what contracts the system, which is what makes the government go, oh no, we need to stimulate the economy.
Correct. Let's
hand out blank checks to everybody again to stimulate the economy, to get things flowing around in circles. I think it's really important to, and it's really hard to question the givens of a system and to go look at what you've just explained and think, does it make sense? And if you were designing a system, would you design it that way?
Yeah.
But it's really hard to actually do that and not just look at the notification from realestate.com every Saturday that the auction rate clearance and, oh, look, my house is now worth more because CBA sent me an email and therefore maybe I should sell it and buy a better one and buy it and get more debt.
Well, the sad thing is that's actually what it requires, right? For the system to still go, to move higher, for CBA to make more earnings per share, it requires a system to indebt us more and more. That's actually the system.
The irony of calling Bitcoin a Ponzi and this being the banking system and in the way it operates is it's comical.
That's right. The housing minister, Claire O'Neill, has come out and categorically said the housing market will not fall under my watch, which is, I think, in the last sort of 6 or 9 months. I mean, when you dovetail in the corporates and why that is so important, that is why it's important, because fundamentals of our society, how we function, it'll just crumble if we allow the market to do what it wants. And there's no way known the risk, the interest rate paid on a home loan reflects the risk associated with that asset. There is no way known. There is no way known. It can't be that you can borrow at 6% on an asset that has negative cash flow. You can't do that with a stock. Go and get a business that has negative cash flow and ask for a 6% loan. You will not be able to do that. So these are distortions in the market because these are government guaranteed. These are government interventions
and so
driving this distortion.
They're so distorted to the fact that you just take them as a given and this is the world in which we operate.
Yeah.
This is why prices won't and can't go down so that young people can own a home, and this is why the initiatives of a 5% home buyer deposit scheme is now, we'll just use that, just throw that in there. And what's potentially down the track, deductible mortgages from your primary place of residence like they do in America. There is still opportunity for them to kick the can and continue this systematic problem. But
for sure.
Let's contrast it now. So we've contrasted.
Can I just throw in one more?
Go for it.
There's one other interesting. So we say, okay, so Commonwealth Bank is sitting on, at the end of June 2025, $83.8 billion of cash. So, well, that's a lot of cash.
Mm.
But how much do you think depositors have given them?
So that's me. I've got my money in the bank.
Yep.
And they've got 83 billion of cash. I'm tipping all of it is my money. Like all of it is everyone's money. So 100%. That's what I'd guess.
So, well, that's not correct. So depositors over the course of depositors at that point of time are owed $937.8 billion.
Right.
So just to put context, if 10% of depositors came in and said, I want all my money,
yeah,
that would clean out the 83.8 billion, right? So they wouldn't have any money.
So they've got 93 billion in 83 billion on hand, and yet everyone who's put their money into the bank and they check their app and it says, okay, I've got $10,000. You add that all together, everyone's money adds up to 937 billion. 10 times. There's 10 times as much money as what we've given them to what they actually have on hand. And this is why in Europe, if you want to get $5,000 out, they say you need to give us a week's notice to get your money out. This is why when you go and transfer from CBA $10,000 into your Bitaroo account, they cancel and they pause your bank account. And they go, this could be a scam. They're just slowing you down.
Yeah, you now... The way you see when things happen, like you said, whether it's a 24 hours, they put the transaction on hold, you sort of can understand that they're managing on a day-to-day basis these cash flow movements.
Yeah.
Because they have to.
Yeah.
And not only that, they're then lending that out. So what are they doing with all those deposits? Well, they're lending them out. So over $1 trillion of lending occurred. So this credit-based system is about just continuing to ratchet it up to a point whereby it keeps working for them to produce an underlying profit. But, I mean, that is alarming. So we're talking about a system that is government-backed. I get that. And I'll go back to the first point we made, that's going to probably pretty much kick that can further and further down the road. But this is not a true market at play. It's not it's an oligarchy of market because there's 4 big banks who are in this. And there's not a free banking system. In America, there are hundreds of banks that exist, although there's a lot less than there was. There's still a lot more competitive environment. And hence, the passive flows that flow in to these banks on their valuations, CBA being at 26 times earnings, for something that's barely growing at mid-single digits, in an inflation environment at 3%, how is that justified? That on any other listed company, that would be well under the price that it is today, probably less than half that on fundamentals. So, when we go and swing back to strategy, strategy has come out and said at the half year, so that their calendar year is their full year, they made $32.40, I think it is, per share up until the half year. They're calling out they'll do $80 earnings per share by the end of the year. Now, there are assumptions there around Bitcoin price, about appreciation and their accumulation of Bitcoin. So those are assumptions, but just like any business, that's what they're making the assumption, that's how their business model is. But if that is true at $80 a share and their share price is $330, their price to earnings is 5. Well, 5/8.
Yep.
400, it's less.
Yeah.
Now, let's assume it's half that. Let's say it's $40 a share. So we're looking at our earnings per share of around 9 or 10.
Yeah.
The question is that fair value? Now, again, that's up for debate. And again, that's what makes Strategy such a interesting company who's disrupting the traditional credit markets and at the early stages, because they're tapping in, they've only tapped a small portion. They only need to tap in more amounts. And who knows what they'll do with that collateral. They over-collateralize that 10 to 1, yet we're saying that it's a Ponzi. So, I mean, the comparatives are so stark in the opposite direction. You would assume Commonwealth Bank are collateralized at 10-1, yet they're actually collateralized at like 9%. You only need a 13% fall in the housing market, and you have a solvency risk around the Commonwealth Bank themselves.
Yeah.
You're talking about an 80%, 75% fall in Bitcoin, and you still won't have a solvency risk because they can still meet their debt obligation. In fact, they'd be a net buyer of Bitcoin if they could raise more money. So,
I mean, we are comparing a utility of a house versus a store of value or for the Bitcoin. They're different and they're valued differently by society. CBA is viewed based on trust of 50 years, even though go and read some books on the history of banking and you'll ask and question, why do I really trust these entities?
Yeah. I mean, and then add to that the passive flows that come in. So anyone investing in Australia, proportionally, the Commonwealth Bank sits at the top, half a dozen companies, so they get passive flows of support. I mean, the company done a $300 million buyback at an average price of about $115 a share. So, I mean, I thought it was going to be the higher end on the purchase, but there are ways they're propping up the share price for, to maintain this price to earnings, which is far greater than what, the local banking industry operates, let alone the international standards on banking. So, but I think the more important or the most interesting part is what Strategy have done today and what they've laid the platform for the next 5 and 10 years. And, I'll go back to my statement earlier. It has the potential to be the most valuable company listed on the public markets in the next 10 years. It has the potential because if it taps into these areas and then uses the collateral to its advantage, how can somebody else catch them? Because this is an area that has not been disrupted, in recent, in how many decades, if ever. So,
and they're not the only company doing this, although so that is like everyone's competing for the same. It's like the banks working together by all offering credit to buy houses. They work against each other, but they work together because that is a supply demand thing. With Bitcoin, it's the same thing. You've got other treasury companies competing against them, wanting and trying to acquire Bitcoin through debt markets too. But like, what do you see as Strategy's real, I guess, like why do you continue to see it as value if you can succinctly put it now at $330 a share at 1.5 NAV? Like, why should I buy it at 1.5 NAV?
At least I recommend everyone do their own analysis on it.
Yeah.
If Strategy over the last 18 months has more than tripled its Bitcoin position. So I think it, and this is no justification, but I think it hit a high of nearly $500 a share or thereabouts. What was it, 12 months ago or so?
Yeah.
And it had less than half the amount of Bitcoin it has today. So, I mean, Bitcoin continues to appreciate in value. It appreciates in adoption. It's more secure. It has all those attributes we look for in money. That hasn't changed. The basics of why we have bought Bitcoin or why we hold Bitcoin has not altered. Strategy has just accumulated the most of any publicly listed entity. And we're talking streets ahead of anyone. So I think of the 180 publicly listed companies, they all combined hold over 1 million Bitcoin. I think it might be just under 1.1 million.
And they got 64% of it.
Thank you.
Yeah.
So they hold 64% of supply. Now, that will change. There's no doubt. They won't be able to keep buying at the rate. But they're at an advantage because as others buy, it pushes the price up higher because you have true scarcity. So if just that element holds true, the question is, if the earnings rate is 15% of growth every year, then they've got earnings of 15. Now, we just spoke about CBA being on a multiple of 26 times earnings with a growth rate of 5. If they're at 15...
what multiple do they deserve?
Surely they deserve the equal multiple. And if that is true in time, and they're earning $80 a share or $60, $50 a share, then do your sums.
Yeah.
That's what makes it appealing and interesting from my angle. Now, that doesn't mean it won't compress a little bit more, or there won't be volatility. Of course there will be, because there's so much not understood, and we're so early in the adoption phase of Bitcoin itself, let alone strategy and what they've done. But I think in time, as they get included into the S&P, because there's particular requirements for them to do that, I think that'll happen over the next 6, 12, 18 months. And then you combine the ratings agencies being able to rate those 4 products, let alone any others they might come out with, we're going to see more adoption and the ability to raise more money, and they'll be stronger for it. And no other company has built this kind of structure around it, and it is a playbook for others. And he's happy, Michael Strategy is happy to share the playbook.
Yeah.
But also go on their website, go to strategy.com, and the detail they have on each of the products and what they're yielding, the purchase prices of all their Bitcoin, and you can plug in your own assumptions. The transparency of that company and the trust behind it is very strong, because they're basically trying to grow Bitcoin per share for shareholders. And at the base of all that sits strategy itself, which again is like a bit of a turbocharged Bitcoin because of the ability to raise money. So and that, I think, demands some kind of premium. If strategy was to leverage their Bitcoin at 50%, how much more Bitcoin can they buy? And then what would be your premium that you'd put on that? So there's so many scenarios, right? So, and I'm not here to spruik any one of them, but all I look for in an investment, we talk about the hurdle rate being, the S&P, because really that's sort of the rate of inflation, whether that's 10%-ish. And then we talk about Bitcoin being, the hurdle rate. Well, strategy, has earned, I think it's share price performance last 12 months, 120-odd%, 22x. So it's multiplied 22,000% since the year 2020. It's absolutely outstanding. So can that repeat? It's harder, right? Because it's bigger, but it's also not understood. So it's going to take time for the traditional finance to understand it. But if they apply the metrics of a Commonwealth Bank, or apply the metrics of, what they normally apply, admittedly it's not cash flow, they'll come up with a much higher valuation. Where that ultimately sits, time's going to tell.
Yeah, it feels inevitable that the bond market and the debt markets in particular, that are the risk-free return, but now they're known as return-free risk.
Yes.
That they will start adopting other ideas because it doesn't work. It's broken.
Yeah, and then I think your point around the regulatory environment has changed so much. I mean, there are 3 acts going through Congress at the moment that all make, the obstacles that existed prior in the Biden administration pretty much non-existent. And the administration themselves are so much pro-crypto, and they've also announced a Bitcoin strategic reserve. Now, we're not even talking about that.
And that's a bill that's the bill that you're talking about, right?
So, Saylor will be, does a day come when, the US government acquire strategy because of their Bitcoin stack, because they can't catch, for them to buy that kind of quantity.
Well, that's scary. Like, that's the whole Intel thing. We're just going to take 10% of your company, and there's rumors that was just a playbook attempt. Let's see how the market responds to this.
But this fiscal dominance that Lynn Alden talks about is just growing in stature, because the attempt to try and reduce fiscal spending just failed, made if any dent at all. So what we're seeing is an escalation in the recent data in August. So whether that continues, but it's all about growing our way out of it and allowing inflation to do its thing, and possibly, controlling that cost of debt, just because it's such a big play. So I think later in the year, President Xi and Trump are getting together, and that'll be another important sort of discussion around what transpires between the two key figures in global trade and the like. So I think it's in maybe November or something like that. So, but yeah, it's I think strategies, I keep learning more and more and listening to more and more, and I encourage others to do it. And please form your own view. You can see I'm pretty optimistic on it, but I'm also not overweight. I also would encourage people to buy the underlying Bitcoin, because you do have risk through Michael Saylor and his management team, and that could change, whereas Bitcoin is a protocol and you don't get that risk change or that change easily. It has to go through a lot more rigmarole, and
The whole view of these videos is like, understand what you're doing with your money, how to store it, and at least understand the premise to what you're doing and why you're doing it. Don't just do things and go status quo, march in line with all the other goose steppers and just continue to pile into property in Australia. You'll wake up and you'll go, what happened? Why did that happen? Why is my life shit? But at the end of the day, would you rather hold a melting ice cube, or would you rather hold gold, or would you rather hold, an immutable, scarcest asset on the planet?
Absolutely. And I think that's a good way to finish up on. I mean, ask yourself a reason. Why is the value of gold up 45% year to date or thereabouts?
And why are three assets that are supposed to be contrasting, when the stock market's up and house prices are up, gold is generally they're normally contrarian, and now all three asset classes, gold, stocks, houses, they're all up. What's going on? It's not normal.
Yeah, I mean,
and Bitcoin up too. Bitcoin has like a digital gold.
That's right. Gold generally sniffs out
problems,
shit that's going to happen down the track, right? So, and that's where the money's flowing. I mean, a lot of sovereigns, whether it's the BRICS nations, they're all sort of going in and purchasing more and more, and I'm sure citizens are buying their share as well. So whether that continues, I'm not sure. I've never had a real position. I have a real small position in gold, but it's not even. But yeah, Bitcoin I think is the digital gold, and something that we should get exposure to, and I encourage people to definitely get exposure to Bitcoin.
Yeah, legend, Bill. We'll have you back another time.
Yeah, well done. Good chat.